Good morning, everybody. Thank you for being here with us for the monthly update on the Hedge Investment and Credit Opportunities Fund. We're very pleased about the February performance. It was quite strong for us. We're up around 2% for the month. We really like most of the strategy, had a positive contribution. First of all, the macro and opportunistic trading strategy. We saw a decent resurgence of volatility across different asset classes for the month of February, in particularly on government bonds and equity. We've been playing the government bond side from a very short position and the equity side from a more constructive long bias, so buying the dips and then selling the spikes, while on the bond side we remain structurally short. Our view going forward is that we will see a rewind of the movie sequence we have witnessed in the quantitative easing expansion over the last few years. The only problem is that that rewind could be quite fast. So we do expect both equity and bonds to go down in sync. We think the central bank's put option is being repriced by the central bankers with the decent move of the strike farther out. So there is no real put available right now. We do think the demand and supply imbalance on government bond issuance across the world from Japan, Europe, US is getting worse and worse and will probably reach a peak into the summer. Within macro, a very interesting point for us is the United Kingdom. We remain incredibly bearish. We think UK could be the black swan or one of the many black swans that could come up this year. In particular, we think the political situation is deteriorating very fast. We see as the next catalyst the local election that will be held at the beginning of May. After that, I think we could see a decent trigger of political crisis with a choice between Corbyn soft Brexit on one side and then hard Brexit and government stability on the others. Away from that, February was very good for us for the corporate trends. As you know, our corporate trend view is divided in two folds. The first one, short term, is that we will see plenty of mergers and acquisitions. Most of them will be very aggressively levered. And we intend to play them with position long on equity and short in credit with a short credit bias. We've done pretty well in February on names like Rite Aid, Biscay, Tele Denmark, Abertis, and there is a plethora of names and situations coming up. We're very involved. We very much like them because they also fits in with our long-term view, which is what we call the technological winter. Lots of those merger and acquisition transactions are being done out of desperation. Part is opportunistic releveraging, part is desperation because the competition is increasing across all sectors. The tech giants, not just the American but the Chinese as well, are competing across all the fields, whether it's retail, banking, services, and we think that will only accelerate over time. And so mergers and acquisitions are one way to defend themselves, but that's not necessarily the best way. A perfect example is Biscay, which we think is a dying technology, being satellite, but at the same time is being scooped up by Walt Disney, Fox, and Comcast at the same time. Away from that, banks is the last leg. Banks was interesting for us. We made quite a bit of money on special situations. Credito Valtellinese in Italy, Liberbank in Spain, and we view that sector as quite interesting from a special situation point of view in terms of, again, consolidation for different reasons, for cost cutting, but still consolidation is happening in Europe. Away from that, on the 81 sector and the most rate sensitive sector, we're very cautious, quite worried about that and the very high correlation between that and risky assets. With this I close. I thank you very much for your time and I hope to speak with you soon next month. Thank you.